This is the 401k Fridays podcast, and I'm your host, Rick Unser. If you're a retirement plan fiduciary or administer your company's retirement plan, you've come to the right spot. Our format is pretty simple. In each episode, we select a timely and informative workplace retirement plan topic, we pick the brain of an expert guest, and provide you the hard-to-find perspective you need to make informed decisions that benefit your plan, your employees, and company. Now here we go with this week's episode. Do the largest 0.1% of workplace retirement plans in the country, or the mega plans, do things the same as the other 99.9% of plans? As you'll hear from my guest, Charlie Nelson, the CEO of Retirement and Employee Benefits at VOYA Financial, sometimes they do and sometimes they don't. Now, I had a few technical issues and distractions on my end to deal with right before we get started, but once my head cleared and we got going, this is a fast-paced conversation where we hit on some topics and things you might expect us to talk about when it comes to what mega retirement plans are doing, but we also delve into a few important topics you might not be thinking about, like how mega plans are helping employees figure out what their next best financial decision is, or whether the prevalence of 401k lawsuits in large plans influence their decision-making, and how some trends in the large market are actually influenced by the small market. Now, before we get started, if you've been enjoying the podcast, please go to your favorite podcast app and leave a review or rating. Believe it or not, this is a big deal and really helps more people find us in the future. Also, a quick disclosure for this episode: the views and opinions expressed by Charles Nelson are his own. They do not necessarily reflect the views and opinions of VOYA Financial Inc. or the VOYA family of companies, and are not to be construed as individualized investment advice or recommendations. With that out of the way, I hope you enjoy my conversation with Charlie. Well, Charlie, thanks for joining me today on the podcast. Appreciate you taking a few minutes, and I'm really looking forward to hearing what you have to say about what's going on in the world of mega retirement plans.
Well, thank you for inviting me, Rick.
Well, let's just kind of jump into it here. I mean, this entire episode is really based on the premise that some of the largest retirement plans, or mega retirement plans, are, I don't know, maybe incubators or are the leaders for who's going to be kind of shaping ideas and trends that are going to impact the broader workplace retirement plan ecosystem. Is that a good premise? Am I off base? Should we end the call now? What are your thoughts?
Yes, I would say mega plans do some things differently and have been the source of innovation. I would also say that we see in the small to mid-size innovation occurring there as well that moves up market. But if you had to look at a general trend, a lot of the innovation, I think, does start at the top of the market, and different is not always better. I mean, we've seen a lot of things and trends, whether it's unbundling versus, kind of what I'll call intentional bundling. Kind of how these mega plans do business is a little bit different, in that if you have a dedicated DC staff, small businesses, mid-sized businesses can't necessarily afford to have a full-time 401k staff member, where some mega plans may have that, or may have it just for the investments or for the record-keeping component. And then just the general makeups of mega plans, we see differences in terms of how they do business, and some of that kind of trickles down, and some of it just stays because it's the uniqueness of mega employers.
Before I take you down too many of the paths you just started down there, when we say mega plans, I mean, everybody's small is different, everybody's medium is different, et cetera. How would you define mega, or is there sort of a generally defined definition for what the general characteristics of a mega retirement plan are?
You're absolutely right. It does kind of differ a little bit, I guess, and depends on the lens in which one looks through it. But as a general rule, I think many that operate in the true mega segment, we would say that it's generally plans of over $1 billion. Of which in the United States there's about 500 companies that fit that criteria. But uniquely, the vast majority of those, call it 70% plus, are really just with 5 record keepers or providers. So it's that $1 billion plus, kind of more concentrated mega plan, mega employer, if you will, size segment that I think many of us kind of refer to as mega.
And what's really interesting is that certainly 500, and I don't have the stats right at my fingertips, but I know there's hundreds of thousands of retirement plans out there. So we really are talking about the cream of the crop. And then when you also talk about 5 record keepers, again, I don't have an exact count, and even with some consolidation in the industry, there's still 40, 50 plus record keepers that are out there working with the broader subset of retirement plans.
No, exactly. I think Pension and Investment Age tracks some 65 different record keepers of varying plan sizes, assets, and participants. These are providers that are doing record keeping and or maybe possibly providing investment management or other services. So 65. But to your point, the point I was making a moment ago with respect to mega, it tends to be a very few, handful, 5 record keepers that really work in that marketplace, and it's largely driven by the uniqueness of large mega employers, both in their plan design, how they've structured it, the fee structure, and just the general capabilities that a provider needs to have to be able to operate in that segment is very different than what you need in the small to mid-size range.
Yeah, so you mentioned that. Give me a couple examples. Like, what does it take to join that club or to be part of the firms that are doing business with those $1 billion plus or mega retirement plans?
You need to have capabilities around a variety of different benefit structures, plan designs. Oftentimes they'll have multiple payrolls, and to be able to do what is referred to in that size segment as payroll feedback files. So where the payroll files actually comes back, there's exchange of information on the payroll file back and forth between the record keeper and the employer, if you will. In the small to mid-size range, you get your deductions from your 401k plan, you send it to your provider, they post it, that gets, in the participant accounts, and away you go. There's more interaction as an example. Certainly non-qualified plan and the proliferation and the variety of plans, not just one plan, but in a lot of these situations, you could be having multiple qualified plans or non-qualified plans for a single employer. Those types of things are very, very unique, that you don't see as frequently in the small to mid-size.
Now, one of the other things you mentioned a minute ago was that some of the stuff mega plans are doing are good. Some maybe, some are, I don't want to put words in your mouth. I think you said some are different, but not necessarily better. I think I remember that correctly. Mm-hmm. Give me along those lines, give me a couple examples of maybe what you've seen some mega plans do over the last couple of years that has been different and moved the industry down the right path. And maybe like a couple examples of things you've seen, mega plans either think about or pursue that either really haven't been that beneficial or ended up not really going anywhere.
Sure. So, again, these things, as I described, different is not always better. Really depends on the eyes of the beholder and the lens in which you look through, whether it's a good or a bad thing. Certainly, there was the intensity and the focus on fees in the mega market has been there for a number of years. And that focus has driven really the market down to a handful of providers and providers that are really focused at it. It's just not economical for many DC record keepers providers to operate in that unless you've got a certain size and scale. Like we at VOYA, we're very focused in that. We like the large record keeping market. We like to be in that, but it also is a good balance to some of the other components in our business, our tax exempt business, 403b, 457, and our small mid 401k business. So, depending on the lens in which you were looking, you may say, geez, do I want to go and just be a mega plan record keeper? It would be tough to really have a value proposition of mega markets only and have your investors or the shareholder of your company say, boy, this is a company I want to invest in as a provider in that segment. So I think the fee focus is really reduced down, as we discussed a moment ago, the number of providers, certainly relative to the broader 65 that you see, at various plan sizes across the industry.
And is that reduction of numbers of providers, is that based on consolidation, or is that based on people saying, there's the air's a little too thin up here, there's just not enough money for me to be made, and we're going to go focus on other areas of the market?
Well, I think you'd have to, ask some of those providers, but it's probably more of, the amount of spend and effort for what you're getting out of it to operate in that larger end of the market. You've got to have kind of the scale and capabilities to be able to operate efficiently in that size segment. Now, this is not exactly as we defined megas at $1 billion plus. The stat I'm going to give you next is not exactly one that aligns perfectly to it, but it's kind of how I have some of the data within the industry. A Sterling benchmark study, and Sterling does benchmarking of DC providers, where we providers provide a lot of information on our books of business at various plan sizes and by types. They would say that the over 100 million in assets per plan, so greater than 100 million, call that large if you will, and it would include the megas, so it's greater than 100 million, accounts for about 48% of the DC assets in the U.S. DC marketplace. But it only accounts for about 12% of the total industry profitability. And so, you look at that, and to your question, you say, all right, why do some providers not focus there or don't invest to be a provider there? Well, they may say that, there's not enough overall profitability to warrant that investment. A firm like VOYA, and kind of how we look at it with our size and scale, we look at it as providing, significant contribution margin towards our fixed cost and others that make our other market segments, as profitable as they could be. So without it, we wouldn't be as strong, but together it creates a very strong strong and profitable retirement franchise. But just to be in the large or mega market by itself would be probably a pretty tough proposition, if you didn't have something else that was going to generate revenue alongside the DC plan.
One thing you mentioned there a second ago as well is just even though with very few plans, there's a lot of concentration of assets as well that happens within these plans. And I know that where there tends to be a lot of assets, you get a lot of folks in the investment side of the world very interested in providing solutions or kind of catering to that market. I guess when you think about, a small plan or a mid-sized plan that has a couple $1,000,000 or, tens of millions of dollars, are they kind of picking from the same types of investments, or is it a completely different ecosystem for those plans with $1 billion or several $1 billion in it versus in the millions?
Well, I'm going to answer that in two parts. So in the truly mega plans, some mega plans actually have their own investment departments. They may be, part of the treasury or the finance group within that employer. So they're managing enough money as an employer for their enterprise that they may want to manage or manage a portion of the DC assets. They create a fund of their investment management capabilities. In that situation, No, the small employers, mid-sized, wouldn't have access to it. However, I'd have to say that's probably more a minority of employers, mega employers that do that. And I would say generally, if you look across active and passive managers, you'd see the same fund firms and the same types of funds. You may see different investment vehicles. Certainly, collective investment trusts tend to be more popular in the mega size, and they almost tend to white label the underlying manager, if you will, and switch out the underlying investment manager if they don't like their performance, rather than in the small to mid where it's more of a 40 Act type of an investment option. So it's kind of a mixed answer to your question there. Sorry.
Yeah, no, perfect. Yeah, and stay tuned. I'm glad you mentioned collective investment trusts, because that is a topic we're going to be tackling in the next couple of weeks. So we'll hit on that in a different setting. And then yeah, and when you talk about 40 Act, obviously I think what you're talking about there are just mutual funds, registered mutual funds that that have ticker symbols that you'd find on Morningstar or readily available through any major trading platform, versus something that's maybe a little more customized or designed for firms with bigger pools of assets, as in with a collective investment trust.
Exactly. Thank you.
I guess maybe sticking on some things that larger plans have done different. You mentioned hey, there's some of them are a little more complex with maybe a lot of different plans that are out there. Some maybe do things a little bit differently around the investments. You mentioned obviously some of the intense fee competition and how that's really changed the landscape for a lot of people. What else comes to mind as you sit back, as the leader of a major record keeping group who's active in this space? Are there things people are asking for? Are there things coming across your desk? Or, I'm sure there's a lot of people you talk to keep abreast of trends in the marketplace. What are you seeing what else are you seeing mega plans do or ask for that might be interesting to kind of hear about?
Well, without a doubt, in a broad sense, I would say financial wellness and kind of the merging of wealth and health benefits and how employers are thinking about them more broadly is the topic du jour in mega plans. And we're seeing employers really understand and focus much more beyond just, how am I doing on my 401k participation or average deferral rate? And they're understanding that to complete someone's full financial wellness and have an employee that's prepared and ready to be able to retire with a level of income that will, support the family or their needs throughout the retirement years, they need to think more broadly about all the assets that individuals have. So the workplace has become predominantly a source in a lot of ways for financial wellness for many Americans. Many of us kind of look at our workplace for that, and the primary source has been our DC plan or 401k plan. But increasingly, whether it's budgeting tools, whether it's tools and things to be able to understand and think about the trade-offs on paying off student loans or assisting employees to pay off student loans, or even how we think about healthcare savings accounts. And, geez, I've got a high deductible plan at my employer. Where does my next best dollar go? Should I save for my healthcare expenses in retirement in my HSA? Should I do it in retirement? How do I figure out where to allocate the money? We're having a number of discussions with large and mega employers around this kind of decision matrix, around this broader umbrella of financial wellness to help them prepare their employees, to live within the means, help, create an emergency savings account if they don't have one, and think about how they allocate their dollars across the eligible benefits and maybe other demands that they have for expenses as well.
I think that's one of the, obviously, financial wellness and all those little things you just talked about there that kind of go around with it. I think it is very top of mind for a lot of people right now. I'd be curious because this is just my personal opinion experience. I feel like there's a lot of conversation around financial wellness right now. And again, I don't operate in the mega space, so I'm curious about what you're seeing. Is Is it more evolved to actual programs that have some data, programs that have some proof points around behavior changes or other things that they've accomplished within their financial wellness program in the mega space? Or are people really still trying to get their sea legs and figure out what it means to them and how they're going to be tackling this within their workforce?
Well, Rick, I think it's a combination of those things. Certainly, as you indicate, there's a lot of discussion and a lot of questions that are being asked, both of providers, but also of mega employers. We see, kind of the mega employer asking themselves about, well, what role do we want to play in the financial wellness, and how do we want to merge our health and wealth benefit programs? How do we think about that with our employee population as they think about preparing for catastrophic medical expenses or planning for a stream of income post employment, if you will. So we see employers on that end of the spectrum all the way to those that are using, and a greater interest to use plan health and predictive analytics to gain better insights of the workforce. And certainly this is something a lot, maybe easier on some dimensions when you have, a mega plan with $1 billion plus in assets and 10, 50, 40, 100,000 participants, where you can get really good analytics and understand and study your workforce, in a much more comprehensive way than if you were 40 or 50 employer. So we see some using and really taking it all the way to the plan health and predictive analytics, to even going beyond some of those things and trying to figure out how to apply some of the best lessons in behavioral finance in design, in both the plan design, to drive this engagement around financial wellness. So it's kind of a broad mix and complete spectrum of how we see employers engaging on this, from one end completely to exploratory and questions, to the other end where they're using analytics and being more targeted in terms of how they're engaging employees.
How do you feel mega plans are doing finding out where financial wellness belongs within their internal groups? So where in, I don't know, HR or where in benefits does financial wellness belong? And then maybe kind of the quick follow-up or the part B of that question is same thing for HSA plans. Because I'm with you. Like, I totally agree and see this convergence. But I think one thing that some employers are struggling with is, well, okay, is financial wellness, is that something that falls within our existing wellness program that our health and welfare teams manage? Or is this something that, do we need to put this over here with our 401k people? Or, HSA, well, hey, we have an HSA. It's part of our health and welfare package. And, now you're telling me I need to think about it as something to save for retirement. Well, hold on a second. We need to get more people in this meeting now. I mean, I don't know. I'd be curious if you found any groups that have either done a good job, or if that is somewhat of, who's going to handle this stuff as it comes up.
Well, you did a nice job of articulating the challenge that exists, not just within mega plans or even some small to mid-sized employers, that it's, who has ownership. But, to a certain extent, we also see this same question and dilemma, in Congress today. If you went to, whether it's the Senate Finance Committee or some of the other appropriate congressional committees, the people that cover health care benefits and issues are often different individuals than cover retirement issues. Thus, we see within Congress and sometimes within our programs, HSA and a 401k or a DC plan, not necessarily clear direction of what are the policymakers really intending. Are they intending the HSA to be a savings vehicle, or the 401k for my healthcare expenses in retirement? And so it's not just at the employer level where sometimes there's this area of ambiguity, we see it also with the policymakers. Now, the good news is, and I've spent some time in the last 30 days on the Hill speaking to the various groups on this as well, and some others are doing this too, that we're starting to see more dialogue and more connection points, that people see, what, at the end of the day, an employee doesn't care whether it's a healthcare person or a retirement person's job. They see it as, I've got so many dollars that I need to allocate to my benefit program. And I'm trying to understand where best to spend them, if you will, or invest them to cover the needs that I have for myself and potentially my family. We, as an industry and as employers and even policymakers, we need to work together to drive that solution much faster than I think we have to date. But we haven't. I'd have to say, as an industry, I don't think there's been many that have really advanced it significantly. We are doing an awful lot of this within VOYA. We have an employee benefits business, which I actually also oversee in addition to our retirement business, and we're introducing an HSA solution on January 1st of this year, and looking at how we help employers and participants or employees, if you will, determine how best to make those decisions when I have to decide where do I save my money and for what reason. So really kind of working together at provider level, at employer level, and policymaker level. I think there's opportunity for all of us, and we need to advance this pretty fast because the end consumer, the participant, they're raising their hand saying help.
Yeah. Well, and the big disconnect, and I'm so glad you just kind of shared what you shared, because I don't know. I feel like for so many employers, it's, to the extent that they read some of the publications out there or they see some of the, snippets that come across in white papers or whatever. I mean, it almost makes you feel like, oh my gosh, everybody has this thing figured out. How come we're the only ones that don't? So I'm glad to hear you say that it's hey, well, maybe it's not just me. I'll speak for myself that, that doesn't have all the all the linkages figured out, but it's a broader problem that the people are still working hard to make work to, as you said, obviously what we're all in this for is to help the end user, help employees make better decisions, get better outcomes, etc.
No, exactly. And I'll tell you, we're working with a number of industry groups and working directly on the Hill with the policymakers in Congress to really bring this issue to light. And they are speaking, across the various disciplines within Congress, within these committees, and now starting to have these conversations that, oh, wait a minute, I got to, our health benefits council or benefits team needs to speak with the retirement benefits team as we think about these things. And so, I think we're making progress on that. We just need to have a little bit greater sense of urgency at the policymaker level, as well as, as providers, and then ultimately employers, and all the way down to the end consumer, if you will.
Yep. And another thing you said that I thought was so spot on, and I'd love to just have you maybe share a little bit more, either about, what you're seeing or what employers are asking for. But I mean, and I think people can describe it different ways, but I like what you said, which is, next best dollar. How do I spend my next best dollar that I can allocate towards benefits? Is it HSA? Is it 401k? Is it, do I need to student loans, emergency savings, whatever it is? I mean, now with all of this coming together under this umbrella of financial wellness, which obviously is emerging and morphing as we speak, but what are you seeing employers ask for in the mega space? Or again, as a leader of a record keeping group that can pull on a lot of strings and invest in a lot of stuff, what are you maybe thinking about or developing to help advance that conversation?
Well, to be very candid, in the mega and even in the small, mid to large space, we're not seeing as many employers asking about this as we would have anticipated. Asking about the next best dollar for employees. I think there's been a lot of discussion as we've articulated, whether it's wellness, emergency savings, student loans, HSA, but we're kind of thinking down the road. The next step beyond that is, we have all these programs. Where do I allocate? And what we're doing as an organization, and we're certainly investing an awful lot of money, not just in the algorithms and working and piloting different approaches to helping individuals determine where to make that next best dollar, but also applying the behavioral finance lessons that we have from the academic world. There's lots of great lessons to be learned, from the behavioral sciences area around how we think about loss and risk and framing of our choices. It's really important in terms of you can have the greatest next best dollar algorithm, but if it's not framed in the appropriate way, it could lead an individual to make a suboptimal decision. So it's really the marrying of behavioral finance and science with this next best dollar mathematical approach that we are spending an awful lot of time and energy and investing from an innovation perspective to really make sure that when and as we work with employers that now start to ask about this next best technology, that we've really thought it well through and have used the best lessons from the academic world as well as the financial world in terms of how to allocate investment dollars for participants.
All right. On that same note, I'd love to get your thoughts on another one that I feel like we as an industry have talked about a lot, but I don't know. Maybe I'm missing it. Maybe you'll tell me something different. But I feel like this idea of delayed retirement dates impacting company health and company financials with, hey, if somebody can't retire at 65 or 66 and they have to spend more time in the workforce, it leads to higher healthcare costs and maybe bigger workers' comp risks or, lower productivity, whatever. And, hey, if we can help you figure out how to design your plan the right way today, 30 years from now, you're going to be really happy. Is that something that mega plans with, like you said, kind of those broader data sets and, maybe more diversity within their populations from an age standpoint, is that something they're interested in or asking for or pursuing? Or is that maybe another kind of like next best dollar thing where it sounds really good on paper, we're just not getting the uptick or demand for it from the employers?
Well, I think we are seeing it, but seeing it through a slightly different lens and framing than how you describe it. Certainly what you described, a delayed retirement, longevity issue, the impact on an employer's personal benefits, let alone the impact on the individual. People don't work to say, "Oh, geez, I'm sorry, I can't afford to retire." We're all working to be able to get to that point where we can, have choices to be able to live and have the dignified retirement and our older age, so to speak, to hopefully spend time with grandkids and, pursue other interests that we may have. But it falls under the broader umbrella of financial wellness. So they're talking about it a little bit differently than necessarily longevity or delayed retirement. We hear financial wellness is really that umbrella that's really kind of, getting at the point that we need to help people save and protect and plan for retirement. We need to make sure that they can afford to retire when they want to retire, and that they can retire with the definition of retirement that means most to them, not the traditional definition of retirement. Financial wellness is adapting to a broader definition of retirement than, hey, I hit age 65, I go home, play golf, go play with the grandkids or whatever. No, the definition of retirement in America has changed and is changing and is being defined as we know it today. I mean, talk to your family, your friends, and you see people who maybe, they may have, quote, retired from their long-term career, but they're working part-time. They have other outside interests. They're doing a wide variety of things. And some are actually having to continue to work because they can't afford to retire. So that definition of retirement is not a one-size-fits-all, and it can be adjusted and fits under this financial wellness umbrella that we hear employers speak about to us, both mega, small, mid, and large. So we're trying to address that and this delayed, the longevity and delayed retirement by thinking of the broader financial wellness solutions.
And sticking under the umbrella for a second of financial wellness, we saw an interesting IRS opinion letter come out that blessed or said that one employer can make a contribution into their retirement plan if their employees are paying back student loan debt. And, obviously debt and student loans has been, I think, been a big focus and conversation piece for people around financial wellness. Maybe I'll go first, and then so I don't put you on the spot. I don't know. Personally, I think that sounds really cool from a recruiting and retention standpoint. Hey, big competition for talent out there right now, and if I can offer something new and kind of address people that we might want to recruit coming out of college or with financial debt, with student loan debt that they're burdened with, this maybe gives us an edge in the recruiting and retention side. So I totally get that, and I don't want to minimize that, because I think that is very important for people to be able to get the talent they need to grow their businesses. But where I'm struggling a little, and would love to get your feedback or thoughts to the extent that you have them, or if you've heard other large employers talk about this. Is this a good thing to say, hey, you got a bunch of debt, I'll make a little retirement plan contribution for you? And I don't know, like when I think about it, it just, I get it on the surface, but I feel like when you go a couple levels deep, I get a little stuck on, are we actually doing something that's going to be good for people or not if this catches fire in our, in retirement plans?
Well, Rick, I would advocate that it's a very good thing. And I'm glad we're having this conversation about student loan debt and financial wellness and how it connects to retirement plans. I've wondered for many years whether individuals are not saving for retirement because of the burden of their student loan debt. There's been some studies that actually just recently came out from EBRI that, when I first kind of thought about this, and we've been studying it inside of VOYA, one of the things that came up is you said, well, student loan debt's really just, kind of appears for your first, maybe 10 years after you graduate college. Well, actually, that's not necessarily true. Yep. There's a fair bit of data from EBRI and other groups that show that student loan debt continues well into someone's 40s, 50s, and maybe even 60s. And what's counterintuitive about it is student loan debt either A, never goes away, or they've incurred additional student loan debt because of their children or grandchildren in terms of what they're, helping to pay off from a student loan perspective. So we shouldn't think of student loans as short-term, well, relatively short, kind of post-graduation. We need to think about the debt as it covers an employee throughout their working career, and we need to make sure that, if they stop saving for retirement, maybe getting a match into the 401k by paying off student loans is better than not having anything at all. So that's kind of how we're thinking about it, at least how I kind of think about this as well, is I think about it as an enabler to help improve outcomes for individuals. So, I applaud the direction. I hope we can expand some of these things on a broader basis and utilization. We're doing a lot of work in this area in our financial wellness solutions within VOYA, and, we expect it to continue to expand.
So I guess two things on that. One, I think you're 100% right. And again, I've said this a few times on the podcast, but I was very fortunate. I didn't graduate from college with student loans. So again, I've not had to experience it myself. But I think one big thing out there that I like to try to put forward as much as possible, I think there really is a big disconnect between the people that are making benefits decisions and the impact that student loans have on their workforce. I've had conversations about, hey, I don't know much about your workforce. I'm new to your company, whatever it is, but I'm going to bet you this is a bigger problem than you think it is. And it's amazing to see how many people just, oh, no, not our group. No. Which, that's not a problem for us, or whatever it is. And I think that would be my one message that I think is regardless of what happens or what people do, I think recognizing and doing something to help employees with student loans, I think is a definitive. But the one thing that I'm struggling with, and since it sounds like you guys have done a lot of work, so I'd love to, again, I maybe just get one more thought on this and then we'll move on. So when I think about this as a benefit and I say, okay, we've got a lot of turnover, people are leaving jobs after 3 years or whatever it is. So I'm Joe. I've just started with this new company. They're going to make a contribution into my retirement plan. I'm going to pay off my student loan debt. 3 years from now, I go and get a great new job. I've got this $7,000 that I've saved, or excuse me, that my company has put aside for me in my retirement plan. And I'm in my 20s. I'm in my early 30s. I've got a lot of competing financial issues and needs right now. I'm not really sure how it got there. So, hey, if I can walk away with $3,500 and I can use that to pay down a student loan, pay off a credit card, contribute towards my down payment on a house, get married, go off, have a fun weekend, whatever it is, that's where I struggle. Is if again, I think it's great. I think it's really shiny and addresses a lot of important stuff on the surface. But what happens when we put this thing in motion 2, 3 years, 5 years down the road? Are we making this better, or did we did we not really move the needle that much?
Well, that's why I think we have to put it in the bigger perspective of financial wellness and under that umbrella and look at everything in context. It's not, you can't just look at one individual aspect, whether it's DC, whether it's HSA, whether it's student loans, whether it's my emergency fund or whatever. We need to think of things more holistically. We need to help individuals think of their finances more holistically and their budgeting of where they spend money and how they spend it and what types of things. It's interesting, I think if employers aren't thinking about those types of issues, look at the data. The data supports it. This is what is on the minds of individuals, even at work, and how distracted individuals are going to be. We have so many Americans living paycheck to paycheck that we need to help those individuals manage their expenses, manage and budget themselves so that they can live within their means and allocate appropriately to the available benefits. And so for me, it's a broader question. It fits under the financial wellness, and actually there's strong benefits to an employer. I suspect that if employees can budget, manage their expenses, have the appropriate plan, invest and protect coverages, it will create less wage inflation or wage pressure for an employer. Because wait a minute, my employees, everybody wants to make more money, but in the same breath, if we're within our means, I think some of that tension and that focus goes off that. It's just a hypothesis I have. I don't know that there's any great data to support it, but I think if you think about it, you can kind of see if people are feeling good about where they are, that they may have less pressure on their employer for continual wage increase as well.
Yeah, no, I appreciate your thoughts, and this is brand new, so we'll see how this plays out, and we'll see where it goes.
Right.
All right, last thing, and then I'm going to move us away from financial wellness. You mentioned people living paycheck to paycheck, and you mentioned, and I think one of the bigger challenges that a lot of people have is going to be, how do I recreate my paycheck when I stop working? And, as we would call them, income solutions, and that can take you down a lot of different paths, but adding options into a retirement plan or adding services as part of your workplace retirement plan to help employees recreate their income in their working years when they're in retirement has been something I feel like has gotten a reasonable amount of discussion, but I think is still sort of on the shelf. What do you see there? I mean, is that something that's going to catch fire one of these days in retirement plans? And if it does it start in the mega plans? What do you see? What do you think? What would you, what are you in your catbird seat there? How do you see this playing out?
Well, I do see it being addressed, and I see it taking off. The time and when that will be, I think will be somewhat dependent upon the intersection of a number of issues, both regulation, as well as product provider, employer, or plan sponsor adoption of retirement income vehicles within plans, because we see the demand from individuals. To me, I've struggled with, why should someone have to leave their employer's DC plan, go purchase an individual fixed or variable annuity, typically at a higher cost than what they could get if the employer provided a lifetime income vehicle that would protect against market volatility, whether it be based on a fixed interest rate or variable annuity type of a variable income type of an approach. Why should people have to leave? And we see, billions of dollars each year leave DC plans and IRAs to go purchase these vehicles, whereas if we continue to offer them on a more cost-effective basis inside of a DC plan and protected employers from a fiduciary perspective on the regulation side, which is what Congress is working on, that I think we as an industry will really move the ball forward quite significantly. But we need a few things to come together to address this, and it's not just at the provider level; it's at the plan, and even most importantly, I think again, it starts back at the policymaker and regulatory level.
Yeah, and I know you said you spent some time on the Hill, and do you get the sense that things are starting to come around there, or is that still something?
Absolutely,
Okay.
Absolutely. Absolutely. You in all the conversations, there's a sense that this is a challenge we need to address. They're trying to find solutions. It's less about no. It's more about, all right, how do we solve this? And I see that kind of tone and discussion occurring. Certainly there are various opinions in Washington on a variety of topics, but this is one generally that you see people trying to kind of solve within from a policymaker and a regulatory that seems to be fairly consistent, at least from the lens and the individuals that I've spoken with.
And I think, I had a conversation with Phyllis Borsey a little while back on the podcast, and I think kind of sounds like a little bit of what you were saying there is, or she kind of advocated is, hey, build a big table, bring everybody together and get all the opinions, and then try to come up with something that's going to work to help empower and protect the employers who want to do this, because clearly there's a need on the employee side. I'm 100% there.
Yeah, 100% agree with you. I think there are some that would not advocate for or would advocate for different types of solutions to the problem. And that's where, I would agree with the approach of let's get, all the views on the table and, differing from different solutions to the problem of retirement income, and, develop hopefully a approach that addresses the broadest grouping that we can solve for.
Yeah. And then kind of like wellness, and one of the things I've tried to put out there a lot is this should be a process that people go through versus a product that they're maybe buying or thinking about in that way. All right, I'm going to pivot you here, because one of the things that I think one of the concerns by a lot of plan sponsors, whether it's adding retirement income or other things, is, and maybe this is something that's a difference, it's not such a good thing, but it's the large plans, it's the mega plans that tend to get sued. So sticking your neck out there and being that innovator, doing something different, going down that road less traveled, even if you feel like it's something that is going to help your participants, sometimes that doesn't work out so well when the plaintiff's attorneys come knocking. How real is the concern over being sued in the mega space for whether it just be plain vanilla decisions people are making, or how much does 401k litigation play into an employer's desire to take on and embrace some of the stuff that we've been talking about for the last several minutes?
So, I think those that are focused on retirement are certainly keenly aware of the litigation environment, not just at the mega plan space, but certainly at the mega plan space. There's a lot of, awareness to the litigation environment. I would not say it's an area of focus in discussions and proposals, finalist presentations. It's almost become a table stakes that providers will help plan sponsors, manage and try to avoid risks wherever possible. So, I think many of us providers, work very effectively both with advisors, consultants, plan sponsors to manage risks and really make sure that the plan design is appropriate, that would not, put the plan in jeopardy of some potential litigation environment. So, it's an issue, but it's not one that, I think we're spending a lot more time talking about, what we were just referring to in terms of financial wellness, HSAs and student loans, and even more broadly, probably one of the bigger topics that we've been spending a fair bit of time on with plan sponsors that seems to be resonating an awful lot is in how they're addressing the needs of their special needs employees and caregivers in their retirement plans. So, oftentimes caregivers for individuals with special needs, are not really a consideration in a DC plan, but we're spending and seeing a lot more time being spent on that conversation and how employers can assist those workers that maybe are a caregiver or may have a special need.
And that was an amazing conversation I had with Bill Harmon on your team, and he spent some time talking about high impact, low cost financial wellness strategies.
Exactly.
And that was a big focus of his. And really, I don't know. I mean, one of the things I learned so much on this podcast, and that was a great example of where I had no idea of some of the realities and challenges, and also just easy mistakes that people can make if they're just not quite aware of what is available to them, how to structure programs if you are a caregiver or you have special needs in your family. That was a fantastic episode, so I would certainly recommend, Charlie, I appreciate you bringing that up, and if anybody hasn't listened to that,
great.
Yeah, go check out that episode with Bill. Like you, fantastic communicator and just very easy to follow and just very eye-opening for some additional ideas on how to kind of supplement your your wellness plan. So sorry, I guess just coming back to the lawsuit thing, because one thing I will tell you is that I feel like on the small to mid-size part of the market, most all of our clients, especially if you have a general counsel on a committee, they want to know what's going on with 401k litigation. They want to know what are the trends? What's happening? Are people settling? Are people not settling? Are the plaintiffs winning more? Are the defendants winning? Are the defense winning more? Et cetera, et cetera. So that's kind of an interesting thought there, that you've got a lot of people in the small to mid-sized space that they're almost like, oh my gosh, what's going on? Are we doing, is what we're doing gonna get us in trouble? Where, the reality is, if you don't have $500 million in assets, $250 million in assets, there's maybe not as much economic viability to a lawsuit. So, the overall vast majority of people, just quite frankly, just based on the size of their plans, probably aren't going to be having the plaintiff's attorneys knocking down their door saying, we want to come after your plan in a class action. So sorry, that just kind of caught me as a little bit of a little different than what I'd expected you to say about, kind of the overall awareness or sensitivity to lawsuits in the mega plan space.
Yeah, no, as I say, I think, certainly everybody's keenly aware of the litigation environment. They're keenly aware of their fiduciary responsibilities. And I think providers, advisors, consultants, and employers are working together to manage, appropriately the risks and make sure that we can deliver and improve outcomes for all Americans in these plans. And, it really is focused on trying to do the right things for all the employees. And ERISA, wants you to, make sure that you're doing, an appropriate job across as many employees and broadly across the spectrum. So it's certainly an issue, but we're spending a lot more time talking about some of these other topics than we are litigation these days.
Well, hey, I'm glad to hear people aren't just cowering in the corner, waiting to be sued. So perfect. That's good perspective. All right. You've been incredibly gracious with your time. You've shared a ton of info, but what haven't we talked about? What haven't I asked you about, or what don't you get an opportunity to talk about that you think is something that plans of any size, small, mid, large, mega, should be thinking about more, spending more time on, or maybe something that's coming that is not quite as evident to everyone that might garner more of our attention down the road?
Well, we certainly have covered a wide range of topics here in this podcast and our conversation here, and I appreciate the time, Rick. I think there's certainly a number of areas. There's never a shortage of things going on in our industry. I think one of the areas that we touched on a little bit, but I would probably just like to kind of reinforce, because it maybe challenge the listeners to kind of see how they're incorporating the lessons from behavioral finance and science into their plans or into their selection of providers and how they do things. With the advent of and the growth of digital in our decision-making processes of the types of services and products we purchase in our daily lives, and extrapolating some of those lessons to the financial services space may not necessarily all be prudent. Having fast, instinctive decisions over someone just to, oh boy, I'm going to take my account and I'm going to go buy this, or I'm going to cash it out, without really thinking through the tax implications, their long-term needs from a financial wellness and savings and budgeting perspective. So we talk a lot about and are spending a lot more time. I think you'll hear more from us, and maybe it's a topic we can explore at a later podcast, of this concept that we refer to as a digital fiduciary. That employers and even advisors, consultants, and plan sponsors, if you will, need to really think of themselves as a digital fiduciary, not just an ERISA fiduciary. In the traditional sense in ERISA, it's well defined what a fiduciary is. But with the advent of digital tools provided on websites for participants and plan sponsors and how they can manage their account, it's incumbent upon individuals to really think of themselves as a digital fiduciary, not enabling people necessarily to make suboptimal decisions. Are things framed appropriately when they view them on the web or on paper or other types of media? So that individuals can make the appropriate choices, that they're not necessarily, kind of enticed to click really quick, which sometimes some things in the non-financial services world leads us to do. So, we'll be talking more about, kind of the digital fiduciary, how what's that really mean for a plan sponsor, but it's really in the broader context of behavioral finance and science and taking the best lessons that we have from the academic community that have been researched, studied, proven, if you will, and then applying them to how we manage our retirement plans and our retirement assets to really try to drive improved outcomes for individuals. So, as I think about things that we haven't really spent a large time on here in this podcast, behavioral finance and kind of the application of it and how we go forward relative and thinking of ourselves relative as a digital fiduciary, because I think it's something people ought to put on their radar screen as they think in the months and years ahead.
I love it. That's a first. So you heard it here first on the 401k Fridays podcast. And, I will give homage to Mike Myers from Saturday Night Live fame. And I'm not going to remember the name of the skit, but he would always very famously say, digital fiduciary, talk amongst yourselves. So
more to come.
Yeah, exactly. More to come. And hey, I will flag you guys as the ones to come back to pursue digital fiduciary. So I appreciate you bringing it up. And I really appreciate you taking the time. We did cover a ton of ground. I thought you shared a lot of great insight, and certainly whether it's to talk about digital fiduciary or other things, we'd certainly love to have you back sometime down the road.
Thank you, Rick.
And there you have it, Charlie Nelson. Great input. Loved the conversation. Also, loved the fact that we didn't always agree on everything. That's always fun. And specifically, one thing that we maybe had a little difference of opinion on was the combination of 401k and student loans as a new benefit offering that plans will likely pursue in the future. Again, as I shared, fingers crossed, I hope all works out for the best, but I do have some concerns. I expand a little bit more on that in a post that I did for Forbes recently. So just Google search Rick Unser, Forbes, you can find that. Or, hey, if you're an email subscriber, we send all those out to our email subscribers. So that's probably a good reminder that whether you want to subscribe to the podcast, connect with me on LinkedIn, Twitter, or become an email subscriber, just go to 401kfridays.com/subscribe, and you can take care of all of that in one fell swoop. That's it for today. Thanks again for listening. And until next time, I hope you make your Friday a 401k Friday. And now for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.